Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Daniel Siluk, Managing Director and Portfolio Manager at Kapstream Capital, joining us. Welcome to the show, Daniel. Pleasure to speak to you. My first question coming to you is right now, the way markets have been moving since March lows, because we did see a major impact that did come in. And from there, I think it's been a one-way journey for equity markets across the globe. Clearly, if you go to see, there is no major reason why, we're seeing this kind of an up move. Do you see any correlation with what's happening on the back of COVID, what's happening with the equity markets, and what's happening with the money markets right now?
Yeah, look, absolutely. You're right. I think at the moment, the market's really paying most attention to positive news and ignoring some of those negative headlines, whether that be around COVID, as you suggest, rising cases in the Northern Hemisphere, in Europe and the US, rising rates of hospitalization. The markets have really been focused on the positive stories. So those positive stories have been fiscal policy, and the amount of support that governments around the globe have provided. It's been around monetary policy as well, about expansions of QE programs, around the promise by central banks to keep rates on hold. And more recently, of course, it's been around, there's been some euphoria around vaccine developments and, how near a vaccine may very well be. But in our view, a vaccine doesn't cure the economy. There's still a lot of challenges, a lot of, bumps in the road ahead.
Right. So, Daniel, this disjunction that we're seeing between record high US markets and depressed bond yields, do you think that's posing any questions with regards to how sustainable is this rally on Wall Street?
Yeah, look, I think the equity rally and risk markets are very much enamored by the promise from central banks to keep rates on hold. And, they've all promised to maintain rates at a very low level for years to come. So if you look at the Federal Reserve in the US, the dot plot suggests that there won't be any rises in rates until beyond 2023. So the equity markets and risk markets more broadly, that it's not just the S&P, it's also emerging markets, have latched onto that promise. Even increasing cases that you're seeing today in Europe, the ECB has pretty much promised to do some additional measures at their meeting next week. So markets are eagerly anticipating what those new measures may be. And we expect risk markets to be fairly well bid throughout this process. But again, I think the question that you raise is a really valid one. How long can this continue? Certainly in the post-GFC period, we had QE, low rates, expanding balance sheets for many, many years. It took the Federal Reserve in the US about 6 years to raise its balance sheet from 1 trillion to 4 trillion, so a 3 trillion rise. They really learned their lesson from that crisis, and in the COVID crisis, over a 6 to 8 week period, they increased their balance sheet from 4 to 7 trillion. So again, a 3 trillion increase, but in a fraction of the time. So that's the playbook today. The playbook is to act swiftly and act in size in order to support risk markets.
Right. So overall, Daniel, if you go to see in terms of the policies that especially Europe and the US are adopting is loose liquidity right now So the monetary policy easily is telling you that, yes, we are going to pump in money into the system. However, I think now it's more about a fiscal stimulus versus a monetary stimulus where you start needing structural changes on the policy framework and not just liquidity. Taking the aspect into consideration, what's the kind of impact are you expecting with regards to the bond markets?
Yeah, look, the fiscal side of the equation is a really important one. So again, if I draw a comparison back to the period post-GFC and in the Eurozone crisis, yes, we had QE, but at the same time, European governments were forced into fiscal austerity. So you had the fiscal side of the equation operating opposite to the monetary side of the equation. But the point you raise is a really interesting one, because today, in this crisis, we have both the fiscal and the monetary acting together. But in order to generate growth and that structural reform, which is really important, and to have any prospects of sustained growth and sustained inflation, you really do need that fiscal side of the equation. So I think policymakers have recognised that fact, that they weren't able to generate that growth and income in the post-GFC years. So today, equity markets and the V-shaped recovery that we're seeing in some economic data, whether it's retail sales, GDP growth, and the like, they were very deep downturns, but they've bounced back. But I wouldn't necessarily characterise it as a V-shaped, but it's certainly quite a sharp tick higher. And the only reason I wouldn't characterise it as a V-shape is, these growth trajectories, such as GDP, it's upward sloping. So in order to return to trend, we need to see continued and sustained growth. And that's why that fiscal will continue through 2021 and beyond. I mean, again, back in the post-GFC years, we talked about QEs 1, 2, 3, and 4. I really do believe in 2021, it'll be about fiscal package 4, 5, 6, 7, 8. It will continue. It may not necessarily be broad-based, because that doesn't make sense deeper into a recovery period. It'll be more targeted. So obviously the hospitality, tourism, travel sectors will probably get more support than, for example, a consumer staple or a telecom, which has done quite well.
Right. So with all of this right now, if you talk about the central bankers across, do you think their policy will continue to remain extremely accommodative, at least for the next 12 to 18 months? Or do you think will they remain accommodative for a little longer from here on?
I think the level of accommodation will continue for at least 2 to 3 years, to be honest, because we're still at a point where labour markets, there's a lot of slack in labour markets. It'll take time for those labour markets to get back to the levels that they were pre-crisis. We're all enduring, different working environments and working conditions in a post-COVID era. I myself, for example, working 2 to 3 days in the office and 2 to 3 days from home. And so as companies learn to deal with large parts of their workforce working from home and working efficiently and effectively, other parts of the economy suffer. So, the cafe that I drop in on the way to work to get a coffee, doesn't see my business 2 or 3 days a week. And, there's many examples of that throughout the economy. So, look, I really do think that in order to make sure the transmission mechanism from fiscal policy is effective, that monetary policy will continue to remain on hold for a longer period of time. So I think it's well beyond 12 to 18 months. I really do believe it's somewhere in the order of 3 years.
Right. So, if this accommodation or this accommodative stance continues, what's the kind of range that you're expecting bond yields, to trade around? Do you think they will remain at current levels?
In the front end of curves, yes. And that's because the front end of curves are more correlated to central bank policies. So, yeah, we would expect, for example, the 2-year rate in the US, or if I look here in Australia, the 3-year rate, it's undergoing yield curve control, where the RBA has promised to keep it at 10 basis points. So you're not going to see much volatility at all in the front end of curves while that central bank promise exists. However, you will see some volatility in the longer end of curves. So whether it's the 10-year part of the curve and beyond. And that's something we've certainly seen over the last couple of months. The US 10-year got to a low in the 50s, and just a couple of weeks ago, it got to as high as 97 basis points, just a little under 1%. As some of that vaccine news came to market, as the US election results came through with a Biden win, so there was a little bit more euphoria that sent longer end rates higher, but it didn't really move short end rates. So you will see some volatility. You will potentially see some steepening in curves, so that 10-year rate rising as growth prospects, as inflation prospects rise. So we need to be quite vigilant further out the curve.
Right. So, Daniel, are we trying to say that it's the US Fed's active presence that's actually holding the investors from selling or even shorting treasuries and betting on higher yields?
Yeah, look, I think in the near term, their actions will sway markets from that perspective. There's a Fed meeting coming up a week before Christmas, and more and more there's whispers around the marketplace as to whether the Fed does more. Now, they may not do more in notional, in dollar term, in size, but they may extend the weighted average maturity of their purchases should we see some volatility in those back end of curves. So if rates were to break through that 1% mark and perhaps move to sort of 1.25 in the 10-year part of the curve, I would definitely expect to see some action from the Fed to support that longer end and bring it back down.
Right. So basically, we're expecting the Fed to soon begin and concentrate on treasury purchases on the longer end of the yield curve.
Yeah, look, it may not happen in December at the upcoming meeting, but to the extent that you see financial conditions tighten with higher rates, or if you see financial conditions tighter through some more volatility in equity markets, then that's probably the trigger point. Now, the other very interesting sort of factor that we need to contend with is the recent decision by the US Treasury, Mnuchin, not to roll some of those Fed programs that were supporting corporate bond markets, primary and secondary bond markets. So as those aren't rolled on, perhaps it puts a little bit more pressure on the Fed to do more.
Right. So overall, Daniel, taking the correlation between the bond markets and the equity markets, do you think bonds will be able to protect any correction in the equity markets, especially in the US right now? And if that happens, what's the mirror effect are we expected to see on emerging markets like India?
Yeah, sure. Look, the correlations of bonds to stocks, I know historically they have a negative, and it's not really been tested, through cycles at the effective lower bound. So in order for that correlation to work, if we see a negative shock in risk assets, really what we're implying is negative rates. But the Fed has actually been quite, let's call it stubborn or quite determined not to go down the path of negative rates. They don't feel that negative rates are an effective tool for generating that growth and inflation. And if you look at the Bank of Japan and the European Central Bank, they're probably good case studies for negative rates not having worked really in a sustainable manner to generate growth and inflation. And then the other factor that the US needs to consider is they're a deficit economy. Being a deficit economy, you need to attract foreign direct investment in order to fund your deficits. You need someone to be buying those treasuries. And you really want to offer those treasuries at some sort of a positive yield. So a positive absolute yield, and you want some sort of positive slope in your curve as well. So I think the Fed is more likely to hold on to that promise of keeping rates, yes, at zero, the effective lower bound, but in not going into negative territory. So that really presents a challenge in your scenario of what happens when risk assets sell off, the next time round. When do we get that next exogenous shock? And although the Fed may not go into negative territory, the market can take us there. So the Fed funds futures, for example, they did trade briefly with a negative yield in May on the expectation that, worsening conditions, may force the Fed's hand. So you may get a little bit of that, I guess, correlation pickup, a little bit of that insurance from your bond yields, but I don't expect it to be to the same order of magnitude as we saw in previous crises. So, today the risk-free asset, perhaps it's not just a US Treasury, but it may be, investment grade, short-dated debt, which has a little bit more of a yield cushion by virtue of the spread.
Right. So overall, what would your view be on the equity markets? What's your anticipation from here on? Do you think they are overvalued, and are you expecting any corrections in the near term? And if yes, what are the key events we should be watching out for from here on?
Yeah, look, I definitely think markets are overvalued, but they can be overvalued for long periods of time and continue to climb. And so just because they're overvalued doesn't mean that they won't continue to get more expensive. It's quite interesting. One of the investment banks, JPM, conducted a study recently where they looked at about 70 different markets across equities, fixed income, and FX. And it showed that at no point in the last few cycles, so few decades, have there been that many markets which are overvalued so early in an expansion. So that's quite telling. Also, the S&P PE ratio is at a very lofty level. It's around 28. It hasn't been at those levels since the sort of late 90s, early 2000 dot-com boom. So that's another example of overvalued or overstretched markets, on the equity side. But on the bond side, I think, one of the best examples of an overvalued market is if you look at the Greek 10-year bond. The Greek 10-year bond is currently trading at about 66 basis points compared to the US Treasury, where the US dollar, reserve currency of the globe, is trading at about 84 basis points. Now, that Greek 10-year Treasury got to sort of close to 4% at the peak of the COVID crisis. And it was also in excess of 30% yield in the peak of the Eurozone crisis, where, a default was a distinct probability. So just looking at, that weight of central bank policy that's forced money into buying a Greek government bond such that the yield has come all the way down to 66 basis points. I mean, that's, in my view, a really perfect example of a overvalued or overstretched market. But also, it's worth pointing out that this is probably one of the strangest recessions we've ever had in our history. Due to fiscal support from the government, supporting the unemployed and, providing support to small, medium businesses, personal incomes have soared through this recession. They've never been higher in a downturn. So the consumer probably has a little bit of a buffer. Once we do get into a sustained economic recovery, the consumer can certainly keep that wave going for a period of time.
Right. And very lastly, Daniel, what's your view of India's monetary policy, the measures that they have been taking? What would your view be?
Look, we don't sort of operate too closely in the Indian market, unfortunately. But obviously, central bank has challenges, as global emerging markets do, to ensure inflation and growth is generated in a sustained manner. They've got challenges, economically dealing with COVID, as many other developed markets do. So in order to try and sustain economic recovery, I think policy support will be, a key feature of this recovery cycle, which is measured in years, not quarters. So we would expect the Indian central bank, much like many other emerging market central banks, to continue to provide support through lower rates.
Absolutely, and that's what everyone's watching out for as well. Thank you, Daniel, so much for joining us on the show. It was a pleasure to speak to you. Great insights that we picked up. Hoping to speak to you pretty soon, and I hope you enjoyed the conversation as well. And stay safe.
Absolutely. Thanks for having me.